Is investing in the IndiaFirst Life TULIP Plus plan a true upgrade in the ULIP space or just another variation with shiny features? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. But before analyzing this policy, let us first understand a few basic details about it. So this is a non-participating unit-linked individual savings life insurance plan. Some of the key features of the policy are: you get to secure your family's future with life insurance coverage of up to 100 times your premium. You get to receive the full fund value as a maturity benefit at the end of the policy term. You get to choose from 11 diverse fund options tailored to match your risk profile. You also get to boost your savings with the return of premium allocation charges and mortality charges, and you also get to enjoy lower premium allocation charges when you invest a higher premium amount, and you also get to avail tax benefits which are subjected to applicable tax laws, and you also get to pick from various investment strategies to grow your savings effectively and strengthen your protection with optional riders like the accidental death benefit and total and permanent disability rider. And there are benefits like death benefit, maturity benefit, and return of charges available. But as a unit linked policy, there are various charges that will be deducted from your premium, like fund management charge, mortality charge, premium allocation charge, policy administration charge, and discontinuance charges. But there are other charges they do not deduct, like partial withdrawal, revival, switching charge, whereas in switching charge you're allowed to make unlimited switches in a calendar month. But the thing is, although the plan refunds certain charges, it doesn't account for the time value of money. And moreover, some charges here mentioned are deducted regularly throughout the policy term. So over time, what happens? These ongoing deductions can significantly erode your investment value and reduce the long-term returns you can get from this policy. So if you want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. Now let us take a look at the advantages. You get to make unlimited free fund switches to realign your investment strategy as your goals change, and you also get to access your invested amount through partial withdrawals during financial emergencies. And starting from the second policy year, you can redirect your future premiums between funds for added flexibility and personalize your policy by adjusting premium payment frequency, extending the premium payment or policy term, or reducing the sum assured to suit your evolving financial needs. Some of the disadvantages of investing in this policy are: this plan does not offer a loan facility, which limits liquidity in times of financial need, and only the net premium after multiple charges is invested, reducing the actual amount working for you. The risk to return ratio is not favorable, making this a less efficient investment avenue, and a mandatory 5-year lock-in period in this policy restricts yearly access to your funds. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic understanding about this policy, let us now move on to the analysis part of the video, where we are going to conduct an IRR analysis, where we are going to calculate the internal rate of return of this policy based on the benefit illustration given in the policy brochure to help us make a more informed decision. So here, for calculation purpose, let us assume that a 35-year-old male has purchased this policy with a sum assured of 20 lakhs. The policy term is 20 years and a premium paying term is 10 years with an annual premium of 1 lakh. So if premiums are paid regularly, the investor receives the fund value at maturity. So here in the policy brochure, they have provided two assumed return scenarios. One is 4% per annum to indicate the worst case scenario. Another one is 8% per annum to indicate the best case scenario. These are just for example purpose and they are not guaranteed returns. They're just to indicate both extremes of how this policy returns can perform. So at 4% return, the fund value at maturity is 13.60 lakhs, resulting in an IRR of just 2% as per the policy's maturity calculator, and at 8% the fund value grows to 24.33 lakhs with an IRR of 5.82% as per the policy's maturity calculator. Even under the optimistic 8% scenario, the return falls short when compared to other market linked investments which typically outperform inflation. Furthermore, the 20 lakh sum assured is insufficient for robust financial protection. So besides underwhelming returns and inadequate life cover, the plan also suffers from poor transparency in fund management and imposes high charges. These factors significantly diminish its appeal as a long-term investment solution. So as this policy is not giving us a desirable outcome we need, let us now explore an alternative strategy and do a comparative analysis where we are going to compare the policy returns with the alternative strategy returns. So here, instead of combining insurance and investment in one product like the India First policy, we are going to invest in both components separately. So the India First policy offers a life cover of 10 lakhs along with market linked investment exposure. So to make a fair comparison, we are going to consider a pure term insurance policy for life cover purpose with a 10 lakh sum assured, which will cost us an annual premium of just 12,800 rupees for a 20-year policy term and 10-year premium payment term. So this leaves us with 87,200 rupees per year available for investment if you compare the premium budget we had for the India First policy. So first option we have taken is a low risk strategy, which is investing in PPF, Public Provident Fund. So this is a government backed debt instrument. So here, if the surplus amount is invested, the maturity value after 20 years would be 25.73 lakhs. So the IRR is 6.19%, completely tax free. So despite being a low risk debt product, the PPF delivers returns that match or even exceed the TULIP plus 8% return scenario without any market risk or high charges. Another strategy is high risk strategy. So here, if you are an investor with a higher risk appetite, equity mutual funds offer significant upside. So the pre-tax maturity value after 20 years would be 53.23 lakh, while the post-tax maturity value, which is after LTCG tax apply in redemption, it will come down to 47.82 lakhs. So if you calculate the post-tax IRR, it will be 10.34%. So if you have any doubts regarding how the equity mutual fund tax was calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So equity mutual funds, being fully market linked like ULIPs, offer superior returns, greater liquidity and transparency with the added advantage of flexibility in investment and withdrawal. In conclusion, India First policy falls short not only in delivering competitive risk adjusted returns but also in terms of liquidity and transparency. A term insurance plus targeted investment strategy offers better protection, higher returns and enhanced financial flexibility, making it a far more efficient option for long-term financial planning. Then what is the final verdict? Is investing in the India First Life TULIP Plus policy worth it or not? So this policy combines life insurance coverage with market linked investment options. While it does offer a variety of investment strategies and fund choices, the actual diversity is limited. Most fund options have similar asset allocation, reducing the benefit of true portfolio customization. Although the term ULIP, which is a TULIP, suggests a strong combination of term insurance and ULIP, this policy falls short on both accounts. So the life cover is often inadequate and the investment component does not deliver proportionate returns for the level of risk taken. So the plan charges are moderately high when compared to other market linked products, and more importantly, the risk return trade-off is not favorable and it also has a high agent commission. So investors typically accept higher risk in pursuit of higher returns, which is the alpha. But this plan lacks that potential, limiting wealth creation over the long-term period. So when it comes to life protection, it is wise to separate insurance from investment. A pure term life insurance policy offers sufficient cover at a low cost, allowing the remaining funds to be invested in a more efficient vehicle aligned with your goals, time horizon and risk appetite.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.